Ladies and gentlemen, welcome to the Beat of Business, and in this video, I want to talk about why I'm buying Alibaba stock and why I think you should strongly consider buying it too. Alibaba is a Chinese multinational technology company that operates through 4 segments. These 4 segments include core commerce, cloud computing, digital media and entertainment, and innovation initiatives. They were founded by Jack Ma in 1999 and have since become an absolute giant and a household name in many parts of the world. For lack of a better explanation, Alibaba can be viewed as the Amazon of China, and their growth has been very similar to Amazon's, but in recent weeks and months, Alibaba's stock price, along with other Chinese stocks, has taken an absolute beating. Year to date, Alibaba's stock is down over 13% and down more than 25% from its most recent high of $270 a share back in the middle of February. In this video, I'm going to talk about why Alibaba's stock price is tumbling, and then we'll talk about why I think this is an amazing opportunity to invest in Alibaba. But before we jump into the video, if you could do me a quick favor and smash that thumbs up button and hit that subscribe button, it would be greatly appreciated. Alibaba just reported its first quarter earnings results, and from an operational and financial standpoint, things are going relatively well for the company. Now, aside from a few mixed results on their Q1 earnings reports, things are hardly bad, and definitely not bad enough to warrant the type of sell-off that the stock has seen in recent weeks. For example, earnings per share beat analysts' estimates, rising 12% year over year, but they did miss on revenue estimates despite revenue being up 33.8% compared to a year ago. They also added 45 million new annual active consumers, but even that number came in below analyst estimates. If we take a look at Alibaba's most recent shareholder presentation, which was released today, we can look at some June quarter highlights of the company, and we can see that revenue was up 34% year over year, but net income and free cash flow were down. Alibaba now has 1.18 billion global annual active consumers throughout their various business units. Now, to put 1.18 billion active consumers into context, that's almost 15% of the world's population that is active on Alibaba. In terms of how their business segments are operating, their e-commerce segment generated $27.9 billion in revenue, an increase of 35% compared to a year ago. Their cloud computing segment reported revenues of $2.4 billion, which is an increase of 29% from a year ago, and the digital media and entertainment segment reported $1.25 billion of revenue, which was an increase of 15% compared to a year ago. Another thing worth noting from their quarterly investor presentation is that Alibaba announced that they would be increasing their share repurchase program from $10 billion to $15 billion, which is the largest repurchase program in the company's history, because according to them, they are confident of their long-term growth prospects. If we take a look at some company highlights, we can see that the stock is trading at around $195 right now. Now, the company has a market cap of $532 billion, a price to earnings ratio of 23.16, and a 52-week trading range of $179.67 at the low end and $319.32 at the high end. One thing that I always like to do is look at a company's balance sheet, because I don't like investing in companies that have more liabilities than they have assets. And in the case of Alibaba, they have a total cash balance of 483.45 billion Chinese yuan, with total debts coming in at 181.44 billion yuan, which is outstanding and something that I like to see when I am investing in a company. So as you can see, Alibaba reported some mixed results, but why is the stock down over 25% since the middle of February? As you can see from the company's presentation, the financials may have come under analyst estimates, but they aren't that bad by any means. And according to management as well as the broader market, Alibaba has some serious growth potential ahead of it. And the reason that Alibaba stock has taken an absolute beating over the past few months is strictly due to regulatory pressures, mainly in China. Chinese technology companies have been the subject of a regulatory crackdown that has actually intensified in recent weeks and has caused for the largest monthly fall for US listed Chinese tech companies since the 2008-2009 financial crisis. Back in the middle of April, Chinese regulators ordered Alibaba to pay a record fine of $2.8 billion after antitrust regulators concluded that the online shopping giant had been behaving like a monopoly. Chinese regulators have been tightening the screws on China's tech champions in recent months, and President Xi has described the crackdown as one of the country's top priorities in 2021. And Alibaba is hardly the only company being impacted by increased regulatory scrutiny. Pretty much all of the big Chinese tech companies have been impacted in some way or another. And the casualties include the Ant Group, Tencent, Didi, and private tutoring companies like TAL Education. I mean, pretty much all of these companies have paid some sort of fine. And in the case of the Ant Group, they actually had their IPO suspended. While there are many critics of how the Chinese government is handling its tech giants, supporters of this clampdown simply say that the Chinese government is doing what the US government wants to do, but hasn't. At the end of the day, this tech crackdown is a clash between government power and corporate power. And the reality is that here in America and in Europe, we are dealing with these same issues. I mean, how much power and information should our US technology companies like Google and Facebook and Microsoft have? This is something that many of us think about, but none of us are really doing anything about it. At the end of the day, I made this video to provide you all with my research and why I think investing in Alibaba is a great idea. Quite frankly, it's just too good of a deal right now to pass up on. I've been adding to my position over the past week or so, and we'll see how things play out. But if Alibaba continues to go lower, I'll be simply adding more to my position to lower my average cost. My opinion on this whole situation is that the Chinese government really went after these technology companies in a drastic way without realizing the unintended consequences that their actions would have on the capital markets. There is no doubt in my mind that the Chinese regulators will eventually back off, and we are already seeing some of that play out as I make this video. Whether you like it or not, China is on an absolute mission to become the biggest and most powerful economy in the world, and judging from current growth rates, they will be the largest economy in the world sooner rather than later. And to become a prosperous nation and a dominant economy, you need to have dominant companies and you need to have a thriving private sector. And if you ask for my honest opinion, I don't think that Chinese regulators will continue down this road for long, but if they do continue down this road of regulation, the consequences would be enormous, and companies like Alibaba and other Chinese tech companies' growth potential would be greatly hindered. But that's the risk of investing, and that's a risk that I'm personally willing to take. The reason that I like Alibaba is because of the growth I think this company is going to have in the years to come, and at today's valuations, I think this company has a lot of upside potential. Alibaba's revenue has been growing year after year after year, and I don't think that trend is going to slow down anytime soon. And if we look at Alibaba in terms of its market cap, it's roughly a third of the size of Amazon, and I think it has the potential to be bigger than Amazon over the next decade. In fact, I wouldn't be surprised if Alibaba becomes one of the top 3 most valuable companies in the world over the next decade. As China's household income grows and China's broader economy grows, so will Alibaba. The fact of the matter is that even 6 months ago, many analysts had buy ratings on Alibaba when it was trading well above where it's trading right now. In my mind, everything that's going wrong with Alibaba is no fault of their own. It's external pressure in the form of regulation, and I firmly believe that this stock will break out in the next couple of months. And speaking of analysts and their predictions, there are currently 48 analysts covering Alibaba stock, and 47 of those 48 either have a buy or a strong buy rating on the stock with an average price target of $292. Now, I personally always take analyst estimates with a grain of salt, but you can't ignore analyst research altogether. So that's my take on Alibaba. This is my own research, but I do encourage all of you to do your own research. Now, just because I think Alibaba is a buy Doesn't necessarily mean that you think Alibaba is a buy, but I would love to hear from you all. Do you think Alibaba is a buy? Please leave, your thoughts and your comments in the comment section below. Thank you all for watching. I'll see you all next time. Oh, and don't forget to hit that thumbs up button, and don't forget to subscribe to my YouTube channel.